Recording. All right, welcome. So today we are going to review our trades for March, all of our closed trades for March. And I thought it would be a great time to do this because of all the things that are going on in the world. You know, there's a lot of talk around the yield curve inverting, the fears of recession and inflation and the war in Ukraine and the price of oil. And all of these things can really help take our eye off the ball. They can distract us from what we're really doing and the reason why we're doing it, and really turn us into emotional traders, which can be probably the biggest the biggest enemy to trading is when we get emotional and start making decisions based on emotion. So what we want to do is just take a look at the strategy. How did the strategy perform with our closed trades in March, and maybe just take a step back and see why we're doing the things we're doing, why it works, why we have a 92% success rate, and why we think it's something that we should stick with even in the midst of all of this geopolitical risk that that we see in the marketplace. So I'm just going to go through each one of the closed trades. I'm going to share my screen, and we'll take a look at how we did on each of these trades. So here you can see my screen, and I've got the first trade up here. This is CLF, and in CLF, we entered this trade here on February 23rd, and sold a $15 put for 40 cents. And then we're able to exit the trade here on March 7th for 10 cents, taking in a $30 profit on a single lot. That's 12 days in the trade with a 61% annualized return. Now, one thing to notice here too is the $15 put is below the current trading range. In fact, the last time CLF traded at the $15 level was in March of last year. So nearly a year ago. Well, at the time, nearly a year ago when we placed the trade anyway. So there's that's and that's part of the reason why the strategy is safe, in that we're just staying outside of the current trading range and able to collect profits in a fairly short amount of time. Now the next one is Marvel, one that we've traded several times over the last year. This one, again, we entered February 11th, sold a $55 put that we sold for $1.20. We were able to exit it then on March 9th. And let's see, we exited for 20 cents. That was a $100 profit on a single lot, 26 days in the trade, and a 26% annualized return. And again, $55 is well outside of the current trading range. The last time Marvel traded at the $55 level was July of last year. The next trade is ACI. ACI, we entered here. That was on January 18th, and we sold a $24 put. Again, you can see $24 well outside of the current trading range. Last time it had been at or below that level was in August of last year. Exited the trade here on March 15th, and let's see, March 15th, we exited for 15 cents. We had sold the put for 50 cents. So that is a profit of $35, 56 days in the trade, and a 10% annualized return. The next one is Sentinel One. Now, Sentinel One, we sold, let's just move that down there. So we sold a $25 put on January 21st. And we sold that for 60 cents. and we're able to exit that on March 16th for 10 cents. So made 50 cents on or $50 on a single lot. That's $54 in the trade, 54 days in the trade, and a 14% annualized return. And again, Sentinel-1 sold the $25 put, and it has never actually traded at that level. So a pretty safe trade outside of its current trading range, even though it hasn't been trading for real long since June of 2021. Our next trade, NCLH, Norwegian Cruise Lines. This trade we entered here on March 1st, sold the 15 strike put for 55 cents, and exited then on March 18th. Let's see, what did we exit at? 15 cents. So a $40 profit in 17 days for a 57% annualized return. Now, one thing that's interesting about Norwegian Cruise Lines is that it did come down, right after entering this trade, it continued down and tested our $15 strike price. We can see the last time that it had traded at the $15 level was in October of 2020. So quite a while since then, but even though we were upside down in the trade for a while, it came back and we were able to exit it for a decent profit. Next, WW. Now this one is another interesting trade in that we entered it here on January 10th. It's a stock that had been fairly well beaten up, had been down quite a bit from its highs in June of last year. So entered the trade on January 10th, sold a $10 put, and we sold that for 30 cents. We were able to exit it here on March 18th. And what did we at 5 cents? So that's a $25 profit in 67 days for a 14% annualized return. Now, this trade also had gone in the money. So we were upside down, showing a loss pretty much for the entire duration of the trade, but still able to get out of the trade for a profit and not risk a loss, even though had you purchased the shares or had bought a call here, there is no way that you would have been able to exit this trade as it continued down. But even though we entered the trade and it was well below where we entered, we still were able to make a profit on the trade. So that's why we say we can make a profit whether if the stock goes up, if it goes sideways, or if it goes down. The next is Macy's. Macy's, another good trade where we were able to enter on March 1st for, let's see, 55 cents. We sold the $20 strike price. The last time Macy's had traded at the $20 level was in August. We were able to exit Macy's on March 18th, and we exited for 5 cents. 15 cents. So made $40 on a single lot, 17 days in the trade with a 43% annualized return. We've got two more trades to talk about here. CWH is the next one, Camping World. So this is another interesting one to talk about. So just a review of the trade. First of all, entered on January 4th and sold the 31 strike put for 65 cents. Again, another trade that went down pretty significantly. We were still able to exit it at a profit on March 18th. And on March 18th, let's see, the exit price was 20 cents, so made $45 on a single lot. That was 73 days in the trade, showing a loss for most of that trade and a 7% annualized return. But here's the cool thing about Camping World. So we are currently in another trade in Camping World. Let's go ahead and zoom out a little bit here. I want to reset my price scale. There we go. So we are in another trade that we entered, sold the May 23 put at $23, or the 23 strike put. And so the last time Camping World traded at the $23 level was in November of 2020. Now, this is actually the fifth that we are trading Camping World since last August. So since last August, we have, sorry, I just had something pop up here on my screen. There we go. So since last August, we have taken $190 in extra dividends. And that does not include this last trade that we entered a week ago. And during that time, you can see Camping World does pay dividends. It has paid dividends several times since last August for a total of $163. That's on 100 shares. So if you had purchased Camping World and had 100 shares in last August, so if we look at that time frame, so in the August time frame, Camping World is trading in this range. So let's say you bought it for around $40 in August. You would have collected in that time $163 in dividends. However, Camping World has gone down significantly since then. So if you were still holding it, let's say at the time that we exited, you would be down somewhere in the neighborhood. If you bought it at 40, you'd be down about $900. If you're still holding it today, you'd be down about $1,300. We were able to be in and out of this trade several times, collecting $190 and never had to actually own the stock and didn't have to participate in this downward trend. So we didn't have to own the stock and take that $1,300 loss or whatever it is at the time that it was exited. So that's one of the reasons why we love this strategy, why it makes so much sense that we can be in these trades, not participate in the ups and downs. We can be outside of its normal trading range and still take a pretty decent profit in a stock, and we can just do that over and over again. The last position we'll take a look at is INTC. So INTC, we entered this trade on March 14th. Let's see if we can scale this down a little bit. So sold the $40 strike put on March 14th, exited this trade then on March 24th. We sold the put for $1, bought it back for 20 cents, so made $80 on the trade, and we're in the trade for 10 days, and that's a 73% annualized return. Now, this is another interesting one in that if we got to go back a long ways, all the way back to October of 2017 for the last time INTC actually traded at the $40 level. So again, we're staying outside of its current trading range, able to collect the premium and just continue to rinse and repeat, do it over and over again. So all of those trades are ones that closed in March, and that is a total March profits to date of $445 on just trading a single lot. So if you just traded one position, that is $445. So that is our trade review. Those are all the trades that we participated in or closed in March. And you can see now why this strategy has a 92% win rate. So if there are no questions, that is it. Those are all our trades. If you have some, go ahead and drop it in the chat. I see we have a few people here. Happy to answer. We also have Jim Barron in the house. He is the creator of this program and the one that you get the emails from for the signals on a weekly basis. So don't see anything coming in. So, well, thank you everyone for being here, for participating in this webinar. You can see all of the trades and how we just stay out of the way of the market, and why we feel comfortable continuing to trade this even with the geopolitical risk. You know, I give one quick example. I was talking to someone recently about why they told me that they were in cash right now. I said, well, why are you in cash? He's like, well, I just, concerned about the things going on in the world. Well, so we all are, but is there ever a time where there's not something that could affect the, affect the market? Because all of these things truly can affect the price of our stocks. The indexes and the individual stocks, they are affected by all of these geopolitical things, the war in Ukraine, the price of oil, all of this. But what we can do is we can still play the probabilities, and the probabilities are that 92% of these trades will expire worthless, or we'll be able to buy them back for a lot less because we are using time to our advantage. So yeah, Larry asked a question, what happens if you get called on your put? So Jim gave an answer here. Most of the time we take assignment and sell calls. If it's an individual decision, as you can also choose to close the position. So yeah, sometimes just depending on where that particular where that particular stock is trading at the time, lots of times we can take assignment, because we're not trading penny stocks here. We're not trading stocks that aren't that don't have an intrinsic value and that we don't believe can recover. So we can take assignment, hold that, and either wait for it to come back, or like Jim said, we often will sell calls against it and can just continue to play the stock. I always have a goal every year of ending the year with turning all my losers into winners, because the reality is, as we trade, there are going to be some losses. There's no magic pill where we get to have 100% losses or 100% winners, but we can continue to work these positions and not accept a loss, and then by selling calls, or sometimes it makes more sense just to close out the position and enter in again at a lower strike price. You can see, like, if I go back, I'll just share real quick my screen again. If we go back and look at Camping World, you can see Camping World, we were in the money on this trade, and there's nothing saying that we couldn't have been assigned. We were fortunate in that it gave us an opportunity to get out and collect a profit, but we could have been assigned. Had we been assigned, we could either sell calls, we could have just closed the position and entered another one. We did enter another one anyway, because there still is a great opportunity here. And so what could happen here? You know, it could be that that Camping World continues down and we get assigned down here. But look at where it is compared to where it's been. We're going to be assigned then at a huge discount from where it has been, and assigned a lot lower than where somebody holding it at the $40 level is. So we're really getting these stocks at a discount if that were to happen, but that doesn't happen very often. So great question. Let me go ahead and. So I don't see any other questions coming in. Thanks everybody for being here. If you are a extra dividend subscriber, there will be a recording of this in the weekend update, and we'll probably make this available for others as well, although we haven't discussed exactly how that's going to happen. So anyway, thank you. Have a great weekend, everybody, and we'll see you again next week.